All right, welcome to another Tuesday Tidbit. This one is, what is an assumable mortgage? So, an assumable mortgage is a mortgage that currently exists where a new buyer of your property could potentially take over your mortgage. They could potentially assume that mortgage. Now, there's a couple pretty important pieces with an assumable mortgage. Number one, when they assume that mortgage, they are taking over the current loan balance and the current payment schedule. Okay, so if you're 10 years into a 30-year loan, they're ultimately getting a 20-year mortgage. Okay, it doesn't start from scratch. Okay, otherwise a loan could theoretically continue forever. Somebody could assume it every 29 years and just stretch out that rate. Not how it works. When you assume a mortgage, you step in right where the other person left off. And the second part, and it's kind of connected to that first one, if your house has increased in value and now you're selling your house at a higher value, that assumable mortgage has only been going down and down and down. So the question then becomes, how does a potential buyer cover the gap? Okay, how do they cover the difference between what that assumable loan is and the purchase price of that house? That can get rather tricky. Maybe a lender can do a home equity line of credit, maybe they can't. The other part of it is, just because a loan is potentially assumable, and the most common assumable mortgages are FHA, Federal Housing Administration, VA, Veterans Affairs, or USDA, US Department of Agriculture. Okay, truly government financing. Just because a loan is potentially assumable does not guarantee you the ability to assume it. Okay, if that were the case, it would create a lot of really bad situations that could arise. A lender would have originally approved and financed somebody that maybe had a 680 credit score. Well, if a potential buyer came along and wanted to assume that mortgage, what if their score is a 400, right? Could they just automatically assume that mortgage and take it up and keep going things forward? That borrower got a rate based on their 680. So no, the short answer is no. That lender is going to have some say in whether or not that loan is assumable. So be prepared to supply pay stubs and W-2s and bank statements. Be prepared to have your credit pulled. It's a similar process. It's actually usually a lengthier process because lenders aren't necessarily incentivized to have a loan assumed, right? It's not like a brand new loan where they're getting origination fees and they've got contract dates to meet. No, that lender's like, doesn't really impact me if somebody assumes this loan or not. And it's usually the lender themselves that is processing that on behalf. So it's not like you could, hey, my loan is assumable and I use XYZ lender. Now I want to use a different lender. Nope, you're kind of stuck with XYZ lender to handle all of that. So that's an assumable loan. Kind of the pros and cons of it. The big advantage of it is obviously you get to keep the rate intact, but it is a little bit of a cumbersome process. Like I said, it's not really easy to do. It can sometimes take even longer than a normal purchase would. And also there's no guarantee that you will be able to assume it. That's entirely up to the lender. Hope that helps. Thanks. Bye.